War, natural disasters, and economic uncertainty. The last decade has challenged and affected people's attitudes towards investing. But there will always be reasons not to invest. Most of these reasons are totally irrational and can even cost you money in the long run. Hi, my name is Caroline Mon, and I'm a portfolio manager at Claret Asset Management. In this video, I'll debunk 5 common reasons people have for not investing and why believing these myths can cost you. A common investing myth I hear all the time is that investing isn't right for you because you're too young, too old, or you don't have enough money to get started. The reality is, there's no minimum age or net worth required to start investing. Your investment strategy will change over time as you get older and grow your wealth. But if you're keeping money in cash or a savings account instead of investing it, you're losing purchasing power to inflation over the long term, no matter how old you are or how much money you have saved up. If you're a young investor, starting early means you'll benefit from the power of compound interest. Even a small investment can accumulate and grow significantly over time. You can start small and gradually increase your investments as you generate more income or savings. What if you're an older investor? Your golden years can be a great time to invest, as long as your investment strategy suits your needs, your risk profile, and takes into consideration your shorter investing timeframe. A second investing myth is that the only way to win at investing is by timing the market or buying and selling often. Investors are often advised to buy low and sell high, but it's not often mentioned that timing a trade correctly every time is virtually impossible, even for seasoned professionals. Sure, you might get lucky on a trade or two, but long-term investing has historically always been more successful than short-term stock trading. Trying to time the market can lead to missed opportunities. After all, if you wait to buy that stock until its price comes down, you might be waiting forever. In the meantime, you're losing out on dividends and stock price increases. Frequent trades can also lead to extra fees, which will eat away at your returns. Your investing strategy shouldn't rely on predicting when a stock price is about to go up or down. The goal instead is to invest in one or more companies that will provide you with steady, consistent returns regardless of timing. Lastly, actively avoiding market downturns means you're more likely to miss out on the upswing. Just look at what would have happened if you had missed the 10 best days in the market over the last 30 years. If you were trying to time the market since 1993, you'd have most likely missed the 10 best days in the market, reducing your investment return by more than half. A third myth is that investing is a quick way to make money. The reality is, investing is a long-term commitment that requires patience and discipline. While there are stories of investors striking it rich with a lucky trade, these cases are the exception rather than the rule. Sustainable wealth is built over time through consistent investing and letting your money grow. Don't be swayed by the promises of overnight success, as they often come with high risks. A fourth common misconception is that investing is like gambling, inherently risky, and that you'd be better off saving your money in cash. While there are risks of losing money associated with investing, the stock market is fundamentally different than a casino. The probability of winning in the most popular Vegas games never surpasses 50%. In contrast, the stock market has experienced an upward trend approximately 75% of the time over rolling monthly one-year holding periods. When investing, there are also strategies to mitigate risks. Keeping a long-term focus and diversifying your investments across different asset classes such as stocks, bonds, and real estate helps spread out the risk. This is the opposite of how a casino works, where the more time you spend at a table or playing different games, the greater likelihood you'll lose. A final common investing myth is that you need a ton of knowledge or you have to be an expert to invest. With today's resources and tools at your disposal, it's never been easier to start learning about investing. You don't need to be a financial expert. Read up on investing basics, watch our videos on investing tips, and reach out to a financial advisor for insights. There are also affordable diversified index funds available if you're not confident selecting individual stocks. Start small and gradually increase your investments as you gain knowledge and confidence. Remember, investing is a journey. Learn as you go and start as early as possible. For more tips on investing, visit our website at claret.ca or get in touch with us directly by clicking on the links in the description. And don't forget to click on the subscribe button below.